Good morning, ladies and gentlemen. Welcome to IGE Webinar. Today, I'm so very excited with a truly outstanding guest speaker, Mr. Brian Brooks, who commands exceptional respect from international financial community, especially on issues relating to crypto assets. I am confident that his insightful views will help us better understand the recent and prospective trends of crypto market. Now, first, let me introduce our speaker. Brian Brooks is one of the most visionary global leaders in fintech and cryptocurrency. Cointelegraph ranked him 13th on its list of the top 100 people in blockchain. And Cradle placed him on the list of America's top 20 crypto regulatory voices. In January of this year, Crunchbase ranked Brian 10th on its list of global influencers. Brian recently served as the CEO of Binance US, one of the largest cryptocurrency exchanges in the world. From May 2020 to January 2021, Brian served as acting controller of the currency, heading the US government agency that charters and supervises the federal banking system. He also served as a member of the FDIC Board of Directors and as a voting member of the Financial Stability Oversight Council. Often referred to as the first fintech controller and crypto controller, Brian is noted for historic achievements on bank charters, granting the first fintech charter and the first crypto charter, as well as for his work promoting bank fintech partnerships. Earlier in his career, Brian served as the chief legal officer of Coinbase, general counsel of Fannie Mae, vice chairman of One West Bank, and managing partner of the Washington, D.C. office of Melvini and Myers, LLP. Brian has been on board of directors of a number of leading organizations. Brian is also, happy to note that Brian is also an accomplished pianist and a former board member of the National Symphony Orchestra, the Los Angeles Master Chorale, and the Pasadena Conservatory of Music. Perhaps next time we should invite Brian for his piano concert. Brian holds a bachelor's degree from Harvard University and a JD degree from the University of Chicago Law School. With that, let's invite Brian. Now, before we get started with our Q&A conversations, perhaps you may like to give us some sort of orientation for cryptos and tokens are really, what cryptos and tokens are really about.
I would be happy to do that. And first of all, Doctor, let me thank you very much for inviting me today. I know this is a distinguished audience that consists of private sector participants and government officials and journalists in Korea and abroad. And I really appreciate having the opportunity and the platform to have this discussion. I would begin the way that I begin most of these conversations by asking you to put aside what you think you know about cryptocurrency. And let me try and reorient you to what's going on in this activity. The first thing you need to disabuse yourself of comes from the nomenclature of cryptocurrency. Many people encounter this thinking that they should be seeing a currency, right? Like a won or a dollar or yen. And if you think about that, you're inclined to look at the price volatility of crypto assets and to tell yourself that the crypto project is a failure because due to its price volatility and other factors, it's not very functional as a currency. So I'm going to ask you to put all of that aside for a moment. And let me tell you that what cryptocurrencies really are is something quite different from that. Cryptocurrencies are much more like internet stocks in some very important ways. So having said that they're not currencies in the main, that generally they're not intended to serve the function that fiat money serves, What are they about? Well, here's the core project of cryptocurrency. The core project is to take the internet that exists today and to decentralize it. And what I mean by that is today's internet, the internet that we've all lived with for the past 20 years or more, is fundamentally controlled by a very small number of big companies. It's basically controlled by Google, Facebook, and 3 or 4 other global technology companies that collectively control all of the server power that allows information to flow, commercial transactions to occur, and memory to be stored on what we know as the internet. There's a problem with that model, obviously. One problem is the problem of hacking and cybersecurity, which is if one data center is taken down on the internet, you can have losses and outages. But more important than that is in a centralized internet, you have central decision makers who can decide who gets to participate, what the rules of participation are, and who has to be deplatformed. So think about the controversy over the last couple of years involving Twitter, deciding which information can be put up and which information should be taken down, or who's allowed to speak on the platform. Think about those kinds of decisions. Or in Facebook, who gets to participate, what kind of information gets censored for content, and who doesn't have to get censored for content. These are all the hallmarks of a centralized internet governed by central authorities, namely the CEOs of the big companies that control that process. The thinking behind Bitcoin and other cryptocurrencies is, what if we had an internet that wasn't controlled by a company? How would that work? And the answer is, there's more than enough computing power in the world. If you think about everybody's laptop, everybody's cell phone, and all of the other computing power that we carry around with us every day, you could create an alternative internet if you could just connect all of that computing power to a new network. The problem is, how can you do that? And why would any of you listening to my voice be willing to take the time to download the software and connect to your laptop to maintain this new network? That's where cryptocurrency comes in. Cryptocurrency is your reward for doing that. And so let's think about the very first cryptocurrency, which is Bitcoin. The way the Bitcoin network was created, the Bitcoin blockchain, which is just another network, was created was software was written and put out on the internet. You could download this software onto your computer. And once you did that, your computer in the background would start solving algorithmic problems designed to validate a set of transactions happening elsewhere on the network. And if your computer was the one that first identified the correct solution to the problem and validated all of the transactions, you were rewarded with a Bitcoin. So that's ultimately what cryptocurrencies are about. They're about one of two things: either a reward for creating a new network layer, or they're an application that sits on top of that network layer. And every crypto token is one of those two things. This is important to understand because people who believe that crypto is backed by nothing, this is a common viewpoint, especially among traditional finance experts, are missing the fact that, in fact, crypto tokens are backed by the very thing that Google stock is backed by. Namely, the value increases as network adoption of a particular network goes up. So if you think about it, Bitcoin has value precisely because there are tens of millions of people who are transacting across the Bitcoin blockchain. And the more people use and spend and hold and invest in Bitcoin, the more valuable that network becomes. And that's what each token represents, is an ownership stake in that network. So too with Ethereum, which is the smart contract blockchain built for financial apps, among other things. The value of an Ethereum token rises as more developers valuable applications on that network. So it's a reflection of adoption or a reflection of the use of a given application. That's what crypto is all about. And so the reason that's relevant to an audience like this is because crypto is not, the way I always put it, is not trying to replace money. This is a very common misconception. What crypto is trying to do, in a sense, is to transform banking, but not transform money. And I say that because the core function of banks has always been to maintain ledgers of account between a borrower and a lender or a depositor, and to allocate credit, right? And historically, you need a unified central administrator to do that. But with networks, you may not need that anymore. And so again, think of crypto not as replacing money, but as replacing banking, and basically taking what used to be a human judgment activity and making it an algorithmic activity conducted by software on the internet. That's the way to think about crypto. So Dr. Jun, let me throw it back to you because I know we're going to have a conversation about this, but hopefully I've oriented everybody on the true nature of the asset we're talking about. And now we can talk about how that implicates financial regulations, transactional rules, and those kinds of things.
Just to have a better sense about what cryptos are really about. Thank you very much indeed. Now we have a number of questions to explore today. Perhaps let me start with a sort of a big picture. Now, as you may know, there is a such thing as a product life cycle theory, especially in the area of marketing. What that says is that any product, including something like Bitcoin, there is a product out of blockchain technology, as you just said, goes through 4 stages of development. The first stage is the initial sort of beginning stage. Second, rapid growth or takeoff. And then the third stage is maturity, mature stage. And then eventual decline. Now, how would you put the current status of Bitcoin or other cryptos in these 4 stages? If you can apply this sort of a theory to the picture of this Bitcoin or crypto business.
Well, that is a great question. So the first thing I would say is we should talk about Bitcoin over here and then all other cryptocurrencies as a separate category. Bitcoin has become a unique asset in the ecosystem of crypto. It's by far the largest, although its margin is smaller than it used to be. But still, almost half of the crypto market cap that exists today is Bitcoin. So what I would tell you is I think Bitcoin, interestingly, is relatively mature. And I say that because it has hundreds of millions of investors globally. It has $1 trillion of market cap. And in the main, Bitcoin currently isn't trying to be anything other than it is currently. So I think we're seeing a relatively mature Bitcoin. That's not the case with numerous other crypto tokens, however. So let's talk for a moment about the various crypto networks that are built around smart contracts. These are the networks that basically hope to disintermediate banking and broker-dealers as a different means of transacting financial deals relative to the current banking system. So in this world, you have networks that are competing to build the fastest and cheapest technology that allows settlement to happen instantaneously. The first scaled network of this type was the Ethereum network, which is the second biggest of the crypto assets. And Ethereum initially attracted lots and lots of developers building decentralized financial apps on top of that network. So again, if you think of the HSBC app that you might have on your phone, your Goldman Sachs app that you might have on your phone, they're decentralized versions of this being built on the Ethereum network. The problem with the Ethereum network is that while smart contracts was a revolutionary technology, the process by which Ethereum was built was relatively slow and relatively expensive. So Ethereum is not capable of processing the same number of transactions as the Visa network is, nor is it as fast as Visa is. And there's a fee for using the Ethereum blockchain called a gas fee, and they're relatively expensive. So while Ethereum was the best thing that was out there 3 years ago, it's no longer the only thing that's out there. So now there are competing networks, the most famous of which is a network called Solana. It's faster than Ethereum, it's cheaper than Ethereum, but it has the same smart contract functionality. And the reason I mention that is that in the world of non-Bitcoin financial applications, I would say that we're probably not in stage 1, but in your 4-stage process, we're probably in stage 2. We know what the application is, we know what the basic rule set is, but there's a lot of competition to figure out who's going to win. So if you think about, for example, the competition between Facebook and MySpace, or the competition between Borders and Amazon, we're still in the era where that competition is occurring, and we don't know who's going to win yet. And it's possible that more than one will win. Then I would say, outside of the realm of financial services, there are lots of crypto projects that have nothing to do with banking and finance. I'm thinking of, for example, the Filecoin application, which uses crypto tokens to create a decentralized cloud storage service that competes with Amazon and Microsoft. This is a brand new idea, a very buzzy idea, but thus far it's just an idea. No developer has yet built the actual cloud application that will take down Amazon, but the network is live and developers are racing to do that. So that might be more of a stage 1 issue. So I guess what I'm telling you is, coming back to my analogy of crypto tokens as internet stocks, it feels a little bit like the late 90s and early 2000s, where a few of these things are starting to get scale and it's starting to become clear what their applications are. But in the main, it's still too early to know who's going to win. So we don't know yet if Google is going to beat Netscape or not. We don't know if Yahoo will survive or not. And you're seeing a lot of that in crypto as well. So right now, when you buy crypto assets, you need to do so with a thesis about why you think this network is the winner, because you don't want to invest in MySpace if there is a Facebook out there somewhere in the ecosystem.
Thank you very much for clarifying the difference between Bitcoin and other cryptos that you just described. Now, whenever I think of the changes in the price of cryptos, I'm wondering, what are really the driving forces? I know when we talk about equities, bonds, when we talk about macro variables, overnight, the biggest story was rise in treasury bond yield, and that triggered big correction or downturn in the stock market. Now, what would you say about the main determinants of crypto prices? Of course, the supply and demand will decide, but what are the behind those changes in supply and demand dynamics, other than some macro variables? But are there any unique things that investors need to track or pay attention to?
Absolutely, absolutely. It's a great question. So what I would say is, there are macro variables that affect individual crypto tokens in specific ways. And then there are specific events. They may be geopolitical events, they may be cybersecurity events, they may be other kinds of things that affect specific tokens. So let's just start at the highest level and say that one of the things that generally has been good for Bitcoin in particular has been a prolonged period of easy monetary policy. So if you think about when Bitcoin, and Bitcoin's been down a little bit the last few days, but compared to a year ago when Bitcoin was trading at 8,000, Bitcoin has now regularly been trading between 35 and 60,000, okay? And it's been north of 40 for most of the last 6 months at this point. So what explains that rise? Well, the chart, the price chart of Bitcoin in particular, goes on a straight line up, basically at the beginning of the pandemic. That is when the governments, not just in the United States, but globally, started flooding the market with both fiscal stimulus and loose monetary policy, which led to inflation. The reason that generally is good for Bitcoin is because, unlike fiat currency, which can be inflated away through central bank policy, Bitcoin is rationed. There will only ever be 21 million Bitcoin. The pace at which Bitcoin can be discovered through mining activities is controlled by algorithms, so it's not like somebody can discover a whole bunch of it tomorrow. And thus, it has, relatively speaking, a better value store quality than certain other kinds of things. So high inflation generally means more value in Bitcoin. Now, there are other things that also affect Bitcoin. So many people will say, well, gee, it's inflationary and yet Bitcoin fell yesterday or something. So doesn't that disprove your thesis? And the answer is no. There are a lot of other things that also affect crypto prices, including Bitcoin. One of them is that even though Bitcoin is now relatively widely held, it's still much, much more thinly traded than most financial assets that people on this conference would recognize. Bitcoin only has a market cap of about $1 trillion, maybe a little bit less than $1 trillion, which means that it's about 1/15 of the US residential housing market, for instance, nowhere near the GDP of any significant country. And at $1 trillion, that would only make it maybe the 4th or 5th biggest bank in the US, let alone globally. What that means is there's a thin market, which means it's relatively price volatile, right? One large seller can have a significant influence on the price of Bitcoin. Or one macro development like the news from China yesterday, that China is taking even harsher measures toward crypto activities, can cause the price to fall, for sure. In the world of other crypto tokens, though, it's a little bit more complicated than elements. There are regulatory issues that can affect price. There are distribution issues that can affect price, and there are functionality issues that can affect price. Maybe we'll start first just for a minute with regulation. So cryptocurrencies, have value precisely because they are away from the traditional financial system. That's why people like them, is they're easier and faster, cheaper, peer-to-peer, all the things that a bank or a broker-dealer are not. But when a government regulator in a developed world country shows up and says, wait a minute, we think that that crypto token over there might be a security and it might be subject to broker-dealer regulation, that tends to cause the value of that token to fall because nobody was looking for an equity security. They were looking for something that traded away from that system. And so when the government tries to get its hands on it, that tends to cause a sell-off of that token. There are also things that happen involving sort of network outages. So generally speaking, networks are more resilient than centrally managed institutions. But just a couple of weeks ago, there was a network outage on the Solana blockchain, which caused transactions to be suspended for hours and hours and hours. That's a disaster on a system that prides itself on being able to transact billions of dollars a day of throughput. It would be akin to if the FedWire system went down for 7 hours and no payments could be processed in the United States. That'd be a very bad day for the dollar. And so all of those things are going on in terms of exogenous effects on crypto prices. But I come back to, Dr. Jin, the place I started, which is the ultimate thing that gives any crypto asset its value is future adoption rates. So again, think about, why does Google stock have value? Google is the principal access point for the internet globally. And as more internet traffic is created, the value of that portal goes up in direct proportion to network traffic. That is also true with the decentralized internet. So for any given token, you see it rise in value because more people are using it. Simple as that.
Thanks a lot. You mentioned China just before. Clearly, China has been a big story, not just for cryptos, but also for Alibaba and Tencent, or other big tech stocks. And more recently, this Evergrande, this real estate developer issue, default possibilities there. So a lot of news stories are coming out of China. Now, Bitcoin prospect story is also very much linked to China, because Bitcoin mining has been most active in the past in China as well. But the story is changing. As you noted just before, China has just declared all the crypto-related transactions illegal, and that triggered some sell-off in the Bitcoin market. Now, how serious is this? How serious the China's decision stance on crypto markets about the global sort of spillover, if you like, and also related issue appears to be energy-related issues, right? The energy consumption for Bitcoin mining is very substantial, and as you know, the latest story about China has to do with this big shortage in electricity and those issues as well. So all things considered, what's happening in China, what the regulatory authority in China is taking would mean for the future of this Bitcoin and crypto business.
Well, let me answer each of those questions separately. So let's put aside the energy consumption just for a moment and just focus on the macro issue of China's policy here. So there's a sense in which China's negativity toward crypto isn't anything new. This is actually the third time in 5 or 6 years, I'll get my dates a little bit wrong, but in that amount of time, when the Chinese Communist Party, the People's Bank of China, and other authorities inside of the country have imposed restrictions of one kind or another on crypto. This is probably the most severe set of restrictions, but it's not new in kind. It's really new in degree. What I would tell you is the effect of demand among Chinese investors for crypto tokens may or may not have been affected at all. But the ability of the Chinese banking system to support fiat to crypto transactions, okay, that has been shut down, obviously. And now the ban on crypto mining, Bitcoin mining in particular, has had a big effect on a whole host of issues in the crypto ecosystem, since all of the biggest chip makers and many of the biggest mining pools were located in the country. So if you take all those things apart, I begin with the fact that crypto remains a very attractive way of, I don't want to say evading, but of allowing people to not be bound by currency controls. And one of the things that wealthy Chinese in particular have been trying to do for 10 years is find ways of getting their wealth out of the country in a time when the Chinese government increasingly does not want to allow that. So crypto remains a very attractive way of doing that. The issue is it's hard to get your money in your bank account into Bitcoin, given the most recent prohibition of banks supporting crypto transactions. This is where stablecoins become important, though. There are ways of buying instruments that are pegged to a fiat currency and can be liquidated abroad, okay, that allow you to engage in crypto-to-crypto transactions without ever touching the banking system. And so there are ways around some of that. Having said all of that, obviously anything that's atmospherically negative is bad for crypto prices, and crypto prices are down on the news that the Chinese government continues to take these kinds of steps. Having said that, though, listen, these things proceed toward an equilibrium always. That's the nature of all financial markets. And what is happening right now is the major chip makers and the major mining pools from China are leaving the country and setting themselves up in other places, including the Middle East, in some of these Arctic Rim countries like Norway and elsewhere. And why are they doing that? Well, they're seeking cheaper energy. So this may be a good segue for me to answer your second question, which is what about the energy consumption issue? What I would say, first of all, is one of the tragedies of the Chinese government's approach is that a lot of Bitcoin mining in China was located around hydropower facilities, and so super clean energy sources, as compared to other parts of the world where coal-fired power plants and other things are being used to support the electricity used by Bitcoin. So in the short run, it's not a good thing from an environmental perspective that China is now out of that business. Having said all of that, let me just take the environmental question dead on. So people talk about all of the energy consumed by Bitcoin, but they don't ever ask the question, compared to what? So what the data shows is that Bitcoin consumes far less energy than JP Morgan does. Right, just one single company consumes more electricity than all of Bitcoin does, and Bitcoin has generated $1 trillion of market value through the energy that it consumes. It's not clear that JP Morgan has $1 trillion of market cap. Indeed, it's clear that it does not. So one thing to say would be it's a much more efficient way of generating value than some other things that we do in our society, and we never ask any questions of that. We just focus on Bitcoin because it's new. That's one thought. And the second thing, which I think is the most interesting thing in crypto at the moment, is the potential role crypto will play in incentivizing the production of more renewable energy, not less. Here's what I mean by that. And this is part of a movement that in crypto people refer to as the Bitcoin as battery phenomenon. So think about why it is in the world that we don't have more solar and wind power production. Why do we not have more? And the answer is because we don't have very good battery technology. We can store only a relatively small fraction of the energy generated by solar and wind for use in the future. And so generally the way that a solar farm works, just to take an example, is that during the day, the solar farm produces far more electricity than its local electric customers can consume. And so most of that energy is bled off in various ways and wasted. And then at night, there's very little storage of the energy that was produced during the day. And so at night, localities have to turn on their natural gas power generation facilities in order to light homes and heat things at night. There's no incentive to build more electric plants through solar, obviously, because most of the energy produced is wasted and can't be captured. And so as long as there's overcapacity, nobody's going to build another unit. Along comes Bitcoin mining, right? Bitcoin has the ability to consume all of the excess electricity that's produced by wind and solar in a way that makes those things potentially profitable when they're not today. And by consuming the excess capacity, there now is a profit incentive to build more of it. And so in that sense, I think in the medium term, Bitcoin likely is more of a solution than a problem. But having said that, the headlines are the headlines, and ESG activists are important in the investing community, and so we need to speak directly to them, which brings me to my last point about Bitcoin and its energy consumption, and that is somewhere between 50 and 70% of all Bitcoin mining is done using renewables. Now, that's not all, and obviously there's a substantial percentage that's mined using oil and coal, so that is not good. But there are very few industries that are 50 to 70% reliant on clean energy sources. And so A, it's cleaner than many other industries, right? All electricity is not created equal. And B, the demand side factors for the production of more renewable energy is a real positive market force that Bitcoin can bring to bear. So these are things that we need to talk about more overtly than I think the community has in the past.
Thank you, Brian. I put different questions on the table, but you answered in such a structured way. So I very much appreciate your feedback on these questions. Now, since we are very uniquely qualified to address not just the crypto issues, but overall financial system, banking system. Now, the latest development in this digital currency field is, of course, CBDC, central bank digital currency. In your view, to what extent this would affect the crypto markets and also overall banking system?
I appreciate the question. I'm going to be provocative on this question and just stake out a position that I'm very worried and concerned about the growth of CBDCs, not just in China, but globally. So let me try and explain the situation for those of you who are new to this topic as follows. Okay, there are three basic models for a financial system. And I'd ask you to think about a spectrum or a numbering line. So there's a vision, a spectrum, okay? On the spectrum, there's position A, B, and C, okay? On the one side over here, imagine a paradigm that is entirely government dominated. So a central bank is making all of the credit decisions, processing all of the payments, and essentially you have a centrally planned and administered financial system run by the government. That's one model. All the way on the other side of the spectrum over here, you have a different model. You have the cryptocurrency model. In the cryptocurrency model, there's no intermediary of any kind, not the government, not a private actor like a bank. All there is software that allows individual people to transact directly with anyone on the network. So it's sort of like, over here you have the post office in a given country run by the government. Over here you have WhatsApp, which allows us to communicate directly with each other with no intermediary. And those are the poles of a potential financial system. In the middle, in position B on the spectrum, you have what really is the current system in most of the developed West. And that is a world where intermediating between consumers over here and the government over here, you have these privately owned companies called banks or broker-dealers, right? And that has been the consensus model for generations in the United States, Western Europe, Japan, and now really Korea. That model is fragile. It does not have a strong constituency in favor of it. Liberals generally hate the banks because they think banks are preying on consumers. Conservatives tend to hate the banks because they see the banks as not adding value in the system, but just harvesting rents from transactions being done by other people. And yet that is the system we have. What central bank digital currencies reflect, okay, remember the spectrum, is they reflect a migration from this position to this position, the position where the government runs everything. In the crypto community, there is a belief that we should be moving in the opposite direction. We should be empowering individuals through networks as opposed to reinforcing strong central planners through a government-dominated system. But that's not the view of the promoters of CBDC. The country that has the farthest advanced CBDC is China. China has a live central bank digital currency that is active today and in use. There are other countries like Brazil, Peru, and some others that are working on this, including the United States, by the way. But China is the farthest out there. And so what I'd like to do is, just for a moment, tell you three rationales for the CBDC project articulated by leaders at the People's Bank of China. And these rationales collectively comprise the reason why I believe CBDCs are dangerous for capitalist democracies. So the first thing, okay, the first stated rationale that the PBOC has for a central bank digital currency is the idea that a CBDC in China could move the world away from a single currency reserve system centered around the dollar, which is the world we've had since World War II, and move to more of a basket approach where US hegemony is not as powerful. Now, you could debate whether that's a good thing or not. I would argue that the central bank, dollar reserves are one of the reasons for relative global price stability over the last 50 years, but people could debate that. In any case, the China, central bank, the People's Bank of China leadership has made clear that one way to move the world off of the dollar standard is to impose a requirement that inbound foreign investment in China be made in the ERMB token. So if you think about that, China is by far the largest inbound investment market in the world due to its population, its growth rate, and other things. And if you imposed a requirement that US and European and Korean and Japanese venture funds and private equity funds had to make investments in an RMB token as opposed to in dollars, that would, at the margins, tend to require those countries to hold RMB tokens in reserve instead of dollars, because that's the currency they'll need to use to make those investments. So that would tend to have a destabilizing effect on the Bretton Woods environment that we currently live in, first of all. The second thing that PBOC leadership has talked about is the idea that right now there's a global political system around banking led by the United States, which focuses on using money as a tool for sanctions. So, for example, the Bank for International Settlements or the Basel Committee or any of these, or the FATF treaty organization can declare North Korea to be a sanctioned country, or Cuba, or in the olden days, Libya, or whatever. And in doing that, they can prevent any inflows of currency into those countries because all banks globally will be required to cut off ties with those countries. In a world of networks, including in the case of China, a permissioned network for their CBDC, all of a sudden China has an ability to transact with countries like Iran and North Korea and Venezuela and others without going through the system that's governed by the US-led sanctions regime. And so that tends to, at the margins, reinforce the power of dictators and unelected autocrats who currently don't have access to currency, but in a CBDC environment might have access to currency because their currency doesn't have to flow through the banking system. And the last thing that PBOC leadership has said, which I personally find chilling just because I grew up in a Western democracy, is the idea that the central bank will now have the ability to clear individual transactions, and they can decide which payments to approve and which payments to reject. That can be scary, particularly in a one-party political system, because it means that the banking system can now be weaponized against political dissenters. So imagine a world where you want to make a political donation to an opposition party political figure, but for that payment to be made, it has to clear through the central bank, which obviously is led by the government. It's quite possible that the government would, and indeed in this case has said, that they would use their payment clearing power to ban that payment from going forward, thus choking off funds to a disfavored political candidate. Other examples could be a little bit more benign, but I think still scary in a democracy. Like, for example, think about tobacco or any other substance or product that is a health concern. You could imagine a government saying, we have too many people smoking cigarettes, that creates mortality risk in the system. And so the way we're going to get people to quit smoking is we're not going to let them buy cigarettes anymore. Now, maybe we can't pass a law banning cigarettes, but again, we can weaponize the financial system to prohibit those payments from clearing. And thus they will no longer be able to buy cigarettes or whatever other vice good, alcohol or whatever else that you think is problematic. We've generally not allowed those kinds of things to be built in the democratic West, or, for this matter, in democratic parts of Asia, because we believe in pluralism. We believe that one man's trash is another man's treasure, and you can spend your money on cigars, I can spend my money on pianos, and it's all the same. But once the government can decide which transactions are prohibited, your zone of freedom in a democracy is reduced. So there is an alternative, I just want to say, to central bank digital currencies. That's not the only way to build an instant settlement, faster payments system, which by the way, is the stated objective in most countries of a CBDC regime. The alternative are stablecoins, which are crypto tokens built on permissionless public blockchains that represent an interest in an underlying asset like yuan or dollars or some other fiat currency sitting in a bank account. But they have the benefit over other means of electronic wealth transmission of instantly settling as they transact across the blockchain. That's different, as you know, from trying to use an app like Venmo or Zelle, where really all you're doing when you hit the electronic button on your phone is you're sending instructions to your bank to contact the recipient's bank to make a series of underlying bank transactions. So those are not anything like instant settlements, but stablecoins are instant settlement bearer instruments, and they have all of the value of the internet while still having the price stability of fiat currency. That is an existing alternative to CBDCs that don't present any of these control problems I'm talking about, and I think are much more consistent with open societies.
Your point on the potential risk associated with the introducing CBDC, especially in China, as part of their efforts to promote yuan as a global anchor currency. There's certainly a danger, risk that we have to recognize, and I think that is subject to much scrutiny and debate down the road to safeguard international financial system. I think that was a very important point. Now I'm getting some questions through chatting room. So I think you have already touched upon this, but to respect our members' view, a question, let me read this for you, also related to China. China's central bank banned domestic financial institutions from supporting crypto transactions in May. And last Friday, China's regulator made it illegal for exchanges to provide services to Chinese users. What are the implications of these restrictions by Chinese government on the future of digital coin? I think you have covered to a certain extent already, especially the supply and demand of cryptocurrency.
So that's a terrific question. Just to expand on what I said earlier, one thing that's important to understand is that exchanges are merely the on-ramp into cryptocurrencies. So exchanges, if you want to think about it this way, are basically a transient part of crypto. They're the way that we take our dollars in the bank and we migrate them into a decentralized universe. Once they're there, exchanges don't necessarily play a role. So many people, possibly most people who own crypto assets, don't store them on an exchange. They store them either on a hardware wallet or on a software wallet that they control, but not something that's on an exchange. And so for all of the Bitcoin that's owned by individual people and stored that way, they can jolly well send that crypto anywhere they want, and they don't have to go through an exchange. And that's why my point earlier was fiat crypto transactions, where I'm buying a Bitcoin for $1, okay, that's going to be harder to accomplish in China today. But crypto to crypto transactions, where, for example, I convert my Bitcoin into USDC or Tether or some other stable coin, and then I transmit that stable coin out of the country to a wallet address in the US. Let's say I live in Shanghai, but my son lives in Los Angeles. I can simply effectively email him my stable coin, and then he can cash it out here with no violation of the existing rules. And that's not really contemplated in the Chinese regulations yet. Having said all of that, it is still quite possible, since crypto exchanges exist on the internet, for people in China to VPN around the Great Firewall, and access fiat transactions. That is still possible using things like debit cards and prepaid cards and other forms of currency. But the most important takeaway is to understand this concept of unhosted wallets that people have on their phones, or they have it in a hardware form. Those things can't really be stopped. You might think about it as smuggling or something, but the government has no ability to stop those transactions. So I predict those will continue.
I have another question. I'm just reading this for you. Well, certainly you are popular over here. I'm getting a lot of questions in this chatting room. Who's going to set the governing principles of taxation on crypto? OECD or someone else?
Well, this is a great question. So for those of you who follow tax policy, you will have followed the most recent agreement among the G20 to have, and it started with the G20 and wound up being 130 countries who agreed on sort of a global set of principles for corporate tax in the world. We're nowhere near that level of agreement in terms of how crypto should be treated. So even just within the EU, if you want to take that as an example, there are certain countries that have made it a priority to state that there will be no capital gains taxes on crypto capital gains. So Portugal is an example of a country that has taken this position. Malta has also taken that position. There are one or two others. So what I envision is there will be a battle for some time over how to treat crypto. I'm sure the OECD will weigh in because the big developed Western European economies always seem to have their hands in somebody's pocket, and so I'm sure that they will have that viewpoint here too. But there are certain countries that are looking to incubate and grow this technology, and they've made an affirmative decision not to treat crypto like other kinds of assets, right? But instead to treat them as merely an inchoate investment in an underlying network. So my guess is we're going to be fighting about this for 5 years before we have a clear answer. And while the OECD will have a voice, there will be national governments that have voices as well.
Perhaps I may explore this question for you. Since you, as I said before, you had experience in both sides, exchange and also regulatory agency side as well. And also, as you said earlier, the current value of cryptos is a reflection of future value of what the kind of service they provide down the road. You mentioned the example of Google. Now, so understanding that you believe in or hope to have sustained growth in this market for the good of the society and economy as a whole in the world. Now, what would take this is a two-part question, from the vantage point of the regulators and investors. Now, what would it take for regulators to support sustained growth of this market by assuring market integrity and investor protection down the road? That's one thing. I think regulators would be keen to have that sort of conditions. And this part of the reason why a number of countries have started, in a way, tightening or fine-tuning their regulatory system governing crypto market. And second part is from investors' point of view. Of course, their time horizon will be all different. Some may take it as a short-term speculative investment, but some others make investment in crypto from a longer-term perspective. Now, what are the factors and issues investors must have in mind to have or sustained return on their investment?
Yeah, well, those are both great questions. Let me start with the regulator side for a moment. So my belief is that regulators should be agnostic as between centralized and decentralized models, but they should treat like risks alike, okay? So in the world of crypto, you have some things that are in fact centralized companies, like Coinbase is an example, right? Coinbase is a company, it has 2,000 employees, used to have a headquarters building, and it's running a matching engine that processes trades and holds cash and also custodies crypto assets, et cetera, et cetera. And so it's a sensible approach to regulation, I think, to say that the centrally managed functions of crypto ought to be regulated to the same extent that those risks are regulated if they occur inside of a bank or inside of a broker-dealer. So think about the rules governing custodians, for instance. In the United States, an asset manager has to have assets custodied with a custodian unaffiliated with the asset manager. That's to prevent the asset manager from stealing the assets or from misstating what's actually there or whatever. So if you're a Coinbase or a Kraken or a Binance, any of these big exchanges, if you're engaged in custody but also engaged in asset management, you should be subject to those same rules. Same thing with liquidity, as you say. You have to be able to provide best execution. You have to be able to clear trades on a timely basis and do certain other things. You have to provide disclosures across an array of activities and the like. Because Coinbase, although it isn't a bank, it is still a central intermediary whose existence and operations affects the safety of your investment if you use that institution. On the other hand, however, the ultimate objective of crypto is not to buy and sell crypto on an exchange. The ultimate objective of crypto is to build a set of technologies that allow currently centralized functions to happen on a decentralized basis without intermediaries. And so when token developers are building networks that allow activities that used to be done by an exchange, right, to now be done through open source software on your phone, in that environment, it's not at all clear to me that we ought to be regulating that activity the same way as we regulate, an actual exchange. Okay, so if I'm running a derivatives exchange like CME Group or something, it makes sense for me to regulate that because there are individual people there who might be engaged in self-dealing or might be committing fraud or doing something else. But if I have a decentralized exchange that is purely based on software algorithms, there are no people to be doing that. It's just a computer program that anybody can look at. So I would argue that the regulatory approach to decentralized software needs to be very different from the regulatory approach to centralized exchanges where the modern regulatory approach makes more sense. The analogy I give here, which I think is really an important one, is once upon a time when people still watched broadcast television, in the United States, we had a government agency called the Federal Communications Commission that granted broadcast licenses to the television stations. And there was a reason that they did that kind of regulation. And that was because if two different television stations were broadcasting on the same frequency, they would create noise and it would be impossible for anybody to watch TV. So we said, okay, you can use this spectrum of megahertz and you can use this other spectrum of megahertz, and it's illegal to use any other spectrum than we've given you. That all makes sense. But then one day somebody invented YouTube, which was also distributing television content. And some people suggested that it was unfair that they did that without getting a broadcast TV license. But I think in hindsight, we realize how absurd that is because unlike the TV broadcasters, YouTube wasn't consuming spectrum. It was simply delivering content in a way that solved that problem. This is where I think regulators miss the point, both in the US and kind of globally, which is we keep trying to shoehorn crypto into the bank regulatory framework or into the securities regulatory framework, when crypto is more like YouTube. It doesn't present all of the same risks that banks and broker-dealers present, and thus it makes no sense to regulate them as though it did. Instead, what we should understand is there's certain incremental risks created, and those have to do with things like the inability to claw back a transaction. So there's no ability to cancel a crypto transaction. So that's a risk. If somebody fat fingers an address and the money's gone forever, how do we think about that risk? Is there some disclosure that should be required or whatever? There's the possibility of money laundering risk, right? Or ransomware risk, those kinds of things, which are incremental new risks introduced by crypto, and we should regulate those. But assuming that the right paradigm for regulating them is the existing bank regulatory framework or the existing securities regulatory framework, to me, makes little sense. And that's the point that I try and talk to people about a lot. Your second question, Dr. Jen, had to do with individual investors and how should they be thinking about all of these factors. With the caveat, of course, that I don't give financial advice. There are two ways of thinking about investing in any asset class. One is you're an index investor, or two is you're an individual stock picker. Harder to be a stock picker. So if you are treating crypto like you're a stock picker and you're deciding, do you want to buy the maker token or the compound token, you need to look very carefully at what's going on inside of that, the same way you do diligence on a company that you were buying equities in. Because the truth is each of these tokens represents a fundamentally different network or different application, and you need to have a belief that that one's going to win, otherwise you shouldn't be buying it. This is why many people who are new to the asset class don't buy those kinds of tokens with that strategy. Instead, what many people do is, as part of their investment strategy, and again, I'm not recommending any particular strategy, but the index-like strategy is to hold a certain percent of Bitcoin, a certain percent of Ethereum, and then one other token reflecting an area that you think is high growth. It could be decentralized finance, it could be gaming, it could be decentralized cloud, it could be a stablecoin project. But typically people have most of their holdings in Bitcoin because Bitcoin is like the index fund. It's the tracking stock for all crypto. Then they have Ethereum because it's the largest of the smart contract platforms, and then they have something else. That's the index-like approach.
That's great. Thank you very much, Brian. I really like your YouTube analogy. That's very intriguing. I think, may I use that somewhere else to talk about this? this regulatory stance on crypto markets. That's a great analogy. It's very telling to all of us. Now it's almost time to close. You're making this time exceptionally in between other meetings. We appreciate that very much. And today, I'm sure our members and audience very happy, delighted to have your exceptional insight, which were very helpful for them to understand what's really happening and what's going to happen in that crypto market. On behalf of our members and participants, I would like to thank you again one more time. It's a pity that we have to close now, but next time when we invite you again, how would you envision yourself? What sort of organization or leadership role you expect to play?
Well, it's hard to know. I have a number of offers to run companies in the crypto space, but I also advise a lot of crypto startups, and I sit on the board of a number of financial institutions. And so, all of us have to decide every day what's the best way for us to make an impact. But you will still see me testifying before the Senate. You'll still see me giving these kinds of talks. And you may well see me as an investor in one of your projects. And if there's a way that I can be helpful, I hope you'll let me know. But it was a real pleasure to be part of this group. Thank you.
Same here. Delighted. Thank you very much for taking time and sharing your exceptional insights with us today. Wishing you all the best. Thank you very much.
We'll see you next time.
Okay. Bye now.